When I owned a mortgage company, there was a product out there called a pick-a-pay loan. And what that product did was you picked a payment every month. You either picked a principal and interest payment, an interest-only payment, or a minimum payment. The minimum payment did not pay even the interest that month, so your balance grew. Hello, Shane Willis, Pensacola real estate expert, bringing you today's episode. Happy Monday. Had a good weekend this weekend. It was actually kind of pretty. A little cooler, but it's warming back up again. So the week before Thanksgiving, right? It always gets cold around here like the week of the fair. And then we have this one more warm snap right before winter really shows up. Although we had that really cold snap there for a second. But yeah, this is all warming back up this week. I think we're back up into the 70s. It's just crazy. Anyways, listen, I wanted to talk today real quick. I've been talking about this before, and I'm hearing it too many places online, so I want to bring it up again, and I want to bring new data, which is what I try and do here. This is not 2008 all over again. I keep hearing it, especially when you see the weekly show that I do, How's the Market, Pensacola, and I talk about an inventory crisis, and we talk about prices continuing to rise. You start to see arguments online, and in even just talks, and I'm talking about other realtors that I'm talking to, that they sense this is kind of something like it's 2008 all over again and we're ready for a crash. And then again, if you listen to 2018, my most popular podcast was when I said recession 2020. You go back and look through the podcast, recession 2020 is when I talked about it, but I'm not going to go over what I talked about in that. If you want to, I'll put it in the show notes. I'll put a link to it so that you can go listen to it. It's about a 10-minute podcast that I explain why it's not the same. But let me give you another reason why it is not 2008 again. All right. The Mortgage Bankers Associations, they release an index several times a year. It's called the Mortgage Credit Availability Index. I'll put a link in the show notes. And it basically says, this is their website. I'm going to read from their website. The MCAI, Mortgage Credit Availability Index, provides the only standardized quantitative index that is solely focused on mortgage credit. The MCAI is a summary measure which indicates the availability of mortgage credit at a point in time. So this is what I wanted to show you guys, and make sure if you're listening to this on SoundCloud or Stitcher or iTunes or something, you click on the show notes so you can see this graph. This graph is crazy, okay? It talks about in 2005, 2004, as we can see, the index said 2004, mortgage credit became more available as the housing market heated up. It became more available. And then the index passed 850 in 2006. Now that number means something, all right? When the real estate market crashed, so did the MCAI below 100. So it got up to 850, way up here. That's 850. It's 8.5 times more likely to get a mortgage. When I was writing mortgages in 2006, 2007, 2008, I know what they were. They were not very hard to get a mortgage at that point. Okay, so it was too easy to get credit. That's what caused that crash because, as it says in the report, it dropped down to 100. Now, that pendulum swung really too liberal in 2004, 5, 6, 7, caused the crash. Swung really conservative afterwards because everybody says it's difficult to get a mortgage. It's not. You just have to prove stuff. It's not, breathe on a mirror and you're approved, which is too liberal. Then we got really too conservative on the mortgage index. But now, as it sits, the index is still below 200. So the pendulum swung a little bit back towards the center. About 350 is about center. It's still conservative. It's too difficult to get a mortgage. That's why we're not dealing with the same housing crisis we did before. We're not dealing with the 3-1 ARMs. 3 years fixed, and then it becomes an adjustable rate. Although the ARM product still exists out there today, it's done totally different. We're not dealing with your pick-a-pay loans. Pick-a-pay loans, and I've told this story before, but I'll tell it today. When I owned a mortgage company, there was a product out there called a pick-a-pay loan. And what that product did was you picked a payment every month. You either picked a principal and interest payment, an interest-only payment, or a minimum payment. The minimum payment did not pay even the interest that month. So your balance grew. Now, before we go crucifying this product of why was this product even out there, it had its purpose. Let's look at that. Let's talk about that cyclical business owner, right? The cyclical business owner. I always use the example of a florist. A florist makes a ton of money in February, Valentine's Day. It's only their second biggest one, though. Their biggest one's actually in May, Mother's Day. Then you have summer, June, weddings. July and August slow down, like really slow down. September, October, weddings start to pick back up, and you're starting to get some of the homecomings, okay? Then November and December, you've got decent revenue just coming from the holidays. January, really slow. Really, really, really slow. Then we pick back up in February, March, slow. Until we get prom season, which happens in April. Then May's Mother's Day. So you get the point. It's cyclical, right? That's what a product like this was built for. So that during the good months, you can pay principal and interest plus some. All right, that was the fourth option. You pay extra principal. Then in the slow months, because you're a business owner, you could pay less than interest. That was what that was built for. The problem was, especially in Central Florida, I was looking all up and down I-4 corridors and seeing brokerage shops opening, selling this product to the person that made the same paycheck every month, every week. It was the police officer. It was the teacher. It was that same salary worker. Well, if you give a salary worker an option of what you're going to pay every month, what do you think the normal option is going to be? The absolute minimum. But, real estate always goes up. The whole reason that product was so popular in the mortgage brokerage business is because the banks, with their appetite and their greed, were paying the brokers 4% of the loan to write them. 4%. FYI, you can't get paid that anymore. All right, 4%. So you do a $100,000 loan, you're getting paid $4,000. And these guys were easy to sell. It was a Wolf of Wall Street type sell going on. I lost 7 loan officers from my shop because when we brought that product on into my mortgage shop, I told them this is for one particular purpose only. And the only way it's going to be approved is if I or my vice president signs off on it. And if it's not a cyclical business owner, we're not signing off on it because I have ethics. And I lost 7 people because they saw it as easy money. All right. That's the type products that do not exist right now. That's why I went up to 800 on that index that I'm talking about in today's show, all the way down to 100. All of those went away. Your arms do exist. Are you going to do 125% of loan to value anymore? No. This is not 2008. Yes, we have seen prices surpass what the peak was in 06. That's okay. That's normal. If you actually looked at the graph, we got way up, way down. Now we're back up. But if you looked at it and actually plotted it out, we're still in a normal growth pattern. All right. So our problem right now is inventory. That's our issue. That's why I say in the How's the Market, Pensacola, I keep talking about a crisis, especially in Santa Rosa County, because everything under $500,000 is a hyper seller's market because of lack of inventory. So you couple low mortgage rates, although it's more difficult to get them. They're not difficult. Do not misunderstand me. It's not difficult to get a mortgage. It is more difficult than back in 2006. Okay? You're actually going to have to prove that you make money instead of what they call liar loans. Sorry. I'll do a whole episode one day on the type of loans that was available in 2006. And you guys, I should do that and put a link in it just so you guys can really see what I'm talking about. But I'm kind of passionate about this because I hear, hey, are we worried about another crash? No, not in real estate. Is there probably going to be a recession next year? Probably. But what does a recession mean? It just means 2 consecutive quarters of lower GDP. That's all. Housing, none of the top economists, none of them say that we're going down next year. Every one of them, 100 of the top economists, 100% say that we're going to go up. We're going to go up 2, 3, 4%, a normal market. That's what we want. That's really what we want. My only concern right now is inventory. If you've got anything you're looking to liquidate, call me. I've had a few phone calls this week. Call me because we need inventory. And even, I know it's the holiday season, but my goodness, we need inventory now because there's people looking now. I've got more investors and more people trying to close by the end of the year than I have houses available. We have an inventory crisis. That's it. It is not 2008 all over again. All right, so there was a little soapbox today. That's all I got for you today. As always, if you've not subscribed to get the tips, tricks, graphs, infographics, get over to 5minutesinrealestate.com. That's 5minutesinrealestate.com. Also, get over to the Facebook page, running some contests starting this week. Facebook.com/Shane Willis, the Realtor. Get over there, hit like, and do me a favor. Share this post so I can get some other people listening. I appreciate it. I really do. Thanks for watching. Have a great day.